A common question is on how people identify the best entry and exit points. There are several approaches to this. Today we learn this video entry and exit strategy first. Some traders focus on doing price action analysis. This is where they simply focus on the price of an asset and then identify unique patterns. The two types of patterns are candlesticks and chart patterns. Candlestick patterns are those like doji, harami, and bullish and bearish engulfing patterns that historically mean something. For example, when a hammer pattern forms, it usually means that the asset price will likely have a bullish reversal. Second, there are chart patterns that tell traders something. These patterns are divided into two: continuation and reversal patterns. When a continuation pattern happens, it usually means that the price will continue rising or falling. On the other hand, if a reversal pattern happens, it means that the trend will start changing. Examples of popular chart patterns are bullish and bearish flag, rising and falling wedges, and head and shoulders pattern. MACD is an indicator that is derived from moving averages. It simply transforms moving averages into oscillators. Therefore, a buy signal tends to emerge when the two lines make a crossover when they are below the neutral line. On the other hand, a sell signal emerges when the crossover happens when the price is above the neutral line. Ichimoku is a leading indicator that has multiple lines. There are several strategies to use it to find entry and exit points. For example, a bullish point can be found when the price moves above the Ichimoku cloud. A sell trade, on the other hand, is found when the price moves below the cloud. The RSI is the most popular oscillator in the market. It is primarily used to identify overbought and oversold trading levels. The bullish signal emerges when it moves to the oversold level and vice versa. However, like all oscillators, these signals can be inaccurate. It is not alwa.